All right, welcome to Talk Tickers. Today, we are diving deep into Hormel Foods' Q3 2025 earnings call. And wow, did the market have something to say about it?
So what does a 13.1% drop in a single day look like? Well, it looks like this. That was the swift and pretty brutal verdict on Hormel's numbers. We're going to break down exactly what happened, why the profits just seemed to vanish, and what it all means for the stock now.
Let's get right to it. The entire story this quarter can be summed up as a tale of two lines: strong sales on one side and collapsing profits on the other. You see, on one hand, Hormel actually beat on revenue. They brought in $3.03 billion when the street was only looking for about $2.98 billion. Sounds great, right? Well, nobody cared. All eyes were on the bottom line, the earnings per share, where they missed pretty badly, just 35 cents versus the 41 cents everyone was expecting. So you've got this sales engine just humming along, but the profit engine completely seized up. And that right there is what triggered the massive sell-off. And when I say massive, I mean it. The stock closed down over 13%, but at one point during the day, it was down a gut-wrenching 18%. The volume was insane, about 5 times the normal daily average. And if you look at the options market, whoa, we saw a huge spike in bearish bets, specifically those $25 put options. This wasn't just some investors trimming their positions. This was a full-blown stampede for the exits.
So the big question is, how does a company beat on sales but miss so badly on profit? Where did all that money go? Well, it all comes down to one thing: a commodity squeeze that nobody saw coming.
And you don't have to take my word for it. The Interim CEO, Jeff Ettinger, basically laid it all out. He said these, quote, unanticipated surges in commodity input costs just completely devoured everything. They ate up the extra profit from their strong sales, and they wiped out all the savings from their big efficiency program. It's like they were running faster and faster on a treadmill just to stay in the exact same spot. And just look at the scale of this problem. Year over year, the cost of pork bellies, for bacon, shot up 30%. Pork trim up 20%. The pork cutout up 10%. All told, these soaring raw material costs translated to a nearly 400 basis point hit to their margins in a single quarter. That is a massive, massive headwind to fly into. And the really frustrating part here, if you're Hormel, is that people are buying your stuff. Demand is actually booming. Retail volume was up 5%, their food services business grew 7%, and international was up 8%. Your big brands like Spam and Jennie-O are flying off the shelves. So you see the conflict, right? The demand is there, but the cost to actually make the product is just eating the company alive from the inside out.
Okay, so faced with this absolute margin meltdown, what's the plan? Well, the new leadership team came out with their playbook for how they plan to fight their way back to profitability. It's a pretty classic two-part strategy. First, they're going to use targeted price hikes across their products to try and pass on some of those insane costs to us, the consumers. And second, they're putting the pedal to the metal on their big internal cost-cutting program, something they call the Transform and Modernize initiative. Now, this Transform and Modernize thing, or TNM, isn't just some corporate buzzword. It's a huge multi-year overhaul. We're talking about almost 90 different projects running at once, aimed at streamlining everything from manufacturing to logistics. It even includes partially closing a facility to be more efficient. The goal? To deliver somewhere between $100 and $150 million in savings this fiscal year alone. It's really their main weapon for defending that bottom line.
And you can really feel the shift in tone. Under the new interim CEO, the message is crystal clear. The top priority, the number one mandate, has explicitly shifted to, and I'm quoting here, returning bottom line growth. The days of just chasing sales are over. It's all about making a profit now.
But, despite this plan, the market was laser-focused on one thing, and it wasn't pretty. It was a painful, and I mean painful, reset of their guidance for the rest of the year.
This right here, this was the nail in the coffin. Management just took an axe to their full-year earnings guidance. They went from a range centered around $1.63 all the way down to about $1.44. Slashing your outlook that much this late in the game is a huge red flag to investors that the pain is just getting started.
And they didn't sugarcoat it. Management basically told everyone there is no quick fix here. They said a full profit recovery is now expected to, quote, lag into next year. They're already setting up fiscal 2026 as what they call a prove-out year. Now, in Wall Street speak, that means don't you dare expect a quick rebound. We've got a long, hard road ahead of us.
And as if that wasn't enough, they dropped one more bomb. Their outlook for the fourth quarter came in way, way below what analysts were hoping for.
They're guiding for 38 to 40 cents a share, when the street was looking for almost 50 cents. That miss completely cemented the negative story and confirmed that these margin pressures are probably going to get worse before they get any better.
So that brings us to the all-important question for anyone looking at this stock. You've got strong sales, but a totally broken bottom line and a recovery that's a year away. So where's the trade?
And that brings us to our segment, The Next Call. After digging through all this, we're slapping an underperform rating on Hormel for the near term. And we've got what might sound like an outrageous but pretty plausible trade idea cooking.
So here's the thesis. We think the market, even after this huge drop, might still be underestimating just how long this margin pain is going to last. This feels like a 2026 recovery story, not a 2025 one. So the trade idea is a long put spread. What does that mean? You'd buy a near-term put option, maybe a Q4 expiry with a $24 strike price, and you'd help pay for it by selling a put that's even further out of the money, say the $21 strike. This gives you a bearish position with a defined risk, and it pays off if the stock continues to drift lower. What could make that happen? Well, if commodity costs stay high or if consumers start pushing back on those price hikes, that could be the catalyst. Now, what's the risk? The big one is a sudden, sharp drop in pork prices or other costs. If that happens, the stock could rally hard and this trade would be a loser.
And, as always, a quick reminder, this is not financial advice.